Chapter 6 is about disruptive technologies. Many dominant firms have seen their market share evaporate due to the rise of a phenomenon known as disruptive technologies, also known as disruptive innovations. While this phenomenon occurs in a wide variety of industries, it often occurs when the forces of fast, cheap technology enable new offerings from new competitors. Disruptive technologies come to market with a set of performance attributes that existing customers do not demand. Disruptive technologies initially underperform incumbents. However, performance improves over time to the point where these new innovations can invade established markets. VoIP, an acronym for Voice over Internet Protocol, is considered by many to be a disruptive innovation. It refers to the technology used in Internet telephony. Seeking the opinions of venture capitalists, research academics, and passionate internal engineering staff is a way to recognize potentially disruptive innovations. Big firms fail to see disruptive innovations as a threat because they primarily focus on the bottom line. Kodak once had 145,000 employees, a market share near 90%, and profit margins extremely good. Today, Kodak is bankrupt. It sold off assets to stay alive, and its workforce is about 1/14 what it used to be. Many once large firms fail to make the transition as new technologies emerge to redefine markets. The market-creating price elasticity of fast, cheap technologies acts as a catalyst for the fall of giants. The term disruptive technologies is a tricky one because so many technologies create market shocks and catalyze growth. But there is a very precise theory of disruptive technologies offered by Harvard professor Clayton Christensen. In Christensen's view, true disruptive technologies have two characteristics that make them so threatening. They come to market with a set of performance attributes that existing customers don't value, and over time the performance attributes improve to the point where they invade established markets. These attributes are found in many innovations that have brought about the shift from analog to digital. All these changes were enabled by fast, cheap technologies. Those running big firms fail to see disruptive innovations as a threat because they do what executives at large, shareholder-dependent firms should do. They listen to their customers and focus on the bottom line. The majority of a firm's current customers don't want the initially poor-performing new technology. The most disruptive technologies also often have worse margins than the initially dominant incumbent offerings. Since these markets don't look attractive, big firms don't dedicate resources to developing the potential technology or nurturing the needs of a new customer base. Early customers for a disruptive technology are part of a different value network than anything addressed by incumbent market leaders. Over time, the disruptive technology becomes good enough to appeal to customers of incumbent products and invades these markets. By the time the new market demonstrates itself, startups have been at it for quite some time. They have amassed expertise and often benefit from increasing scale and a growing customer base. The brands of firms leading in developed disruptive innovations may also now be synonymous with the new technology. Firms can recognize potentially disruptive innovations by paying attention to the trajectory of fast, cheap technology advancement and new emerging technologies. Seeing the future involves removing short-sighted, customer-focused, and bottom-line obsessed blinders. Having conversations with those in the experimental edge of advancements is key. Top-tier scientific researchers and venture capitalists can be particularly good sources for information on new trends. Increasing conversations across product groups and between managers and technologists can also be helpful. Employees who feel so passionate about a trajectory for future technology that they are willing to leave the firm and risk it all on a new endeavor may be a signal that a development is worth paying attention to. A Businessweek cover story on Yahoo CEO Marissa Mayer's challenges stated that at the time Mayer took over, Yahoo was a weak player in mobile because it ran into a classic innovator's dilemma, the name sometimes ascribed to disruptive innovation theory and the title of one of Clayton Christensen's books. The mobile group was disbanded by a former CEO who struggled to justify keeping talented engineers on underperforming projects. Yahoo's mobile team didn't have an executive champion to protect and nurture the team during the pioneering phase when financial results couldn't be realized. It couldn't show substantial results, so managers were reassigned. This is an example of the creosote bush effect. There's no guarantee that a potentially disruptive innovation will in fact become dominant. Trying to nurture new technology in-house is also a challenge. Top technology talent will often never be assigned to experimental products, or they may be pulled off emerging efforts to work on the firm's most lucrative offerings if the next version of a major product is delayed or in need of staff. As disruptive technologies emerge, by definition, they will eventually take market share away from a firm's higher margin incumbent offerings. The result of the transition could include losses, contracting revenues, and lower profits. Christensen suggests a few tactics to navigate the challenges. A firm can build a portfolio of options on emerging technologies, investing in firms, startups, or internal efforts that can focus solely on what may or may not turn out to be the next big thing. It's also important that these experimental efforts are nurtured in a way that is sufficiently separate from the parent. Geographical distance helps, and it's critical to offer staff working on the innovation a high degree of autonomy. Facebook was famously late to the mobile revolution and felt forced to make billion and multi-billion-dollar purchases for Instagram and WhatsApp. And Google News executive Richard Gringas has stated, "We're just as subject as anyone else to missing key trends. The speed of mobile, we miss that. We also miss the powerful trends in social, where frankly we're catching up. That's an ongoing challenge." Sometimes consulted experts get it wrong too. At the dawn of commercial mobile phone technology, AT&T hired storied consulting firm McKinsey & Company to forecast U.S. cell phone use. The McKinsey prediction of 900,000 subscribers was less than 1% of the actual figure of 109 million. Worldwide, mobile subscribers would balloon to roughly 5 billion a decade later. Despite having invented the cell phone in its Bell Labs unit, AT&T cut future investment in the technology based on McKinsey's wildly incorrect prediction. In order to make up for the mistake, AT&T eventually acquired McCall Cellular for $12.6 billion. The need to further expand into mobile was also credited with AT&T's $67 billion merger with Bell South. Sometimes there aren't any easy answers for transitioning a firm that lies in the path of disruptive innovation. The newspaper industry has been gutted by internet alternatives to key products, and online ad revenue for newspapers isn't enough to offset the loss of traditional sources of income. For every Kodak that suffers collapse, new wealth can be created for those who ride the wave of disruptive innovation. One firm that appears to be successfully navigating the rough waters of disruptive innovation is Intuit. Acquisitions are one way Intuit has dealt with disruption. Mint.com is a personal finance offering delivered over the web and in an app that wasn't just cheaper than Intuit's Quicken product, it was offered for free. Intuit decided to buy the upstart rival even though it was clearly cannibalizing Intuit's efforts. It even killed an internally developed but less successful rival product following the acquisition. While so many firms have been thwarted by listening to existing customers and clinging to old models that are about to become obsolete, Intuit has managed to find growth through disruption. One firm threatened by disruptive innovation brought about by the advent of new, fast, and cheap technology is, ironically, processor giant Intel. A market in which Intel never had much success is now threatening to invade the server space. Chips based on Intel rival ARM power nearly all of the smartphones on the planet. Unlike Intel, ARM doesn't manufacture chips itself. Instead, it licenses its hyper-efficient designs to rivals who tweak them in their own offerings. The Intel chips were never designed for power efficiency. They evolved from markets where computers were always plugged in. As Moore's law advances, ARM chips, once computational weaklings, are now fast enough to invade the established market for server chips. HP offers a line of servers that will use ARM logic, and AMD, an Intel rival that has long made chips compatible with Intel's, has a new line of server chips based on the incompatible but power-stingy ARM logic. Meanwhile, Intel has developed lower power chips to attack the smartphone market where ARM dominates. Intel's chip Quark and Curie chips aim even lower, targeting the Internet of Things. To demonstrate possibilities, Intel CEO has been wearing a smart shirt embedded with sensors that monitor heartbeat and other vitals. Who wins remains to be seen. Bitcoin is the transaction method favored by cybercriminals and illegal trade networks like the Silk Road, an online drug bazaar that was shut down. It's not backed by gold or government and appeared seemingly out of thin air. Rather, it is the result of mathematics performed by so-called miners. Many think Bitcoin and similar schemes, often referred to as cryptocurrencies, could upend money as we know it. These technologies have demonstrated enough promise so that venture capitalists have poured over $1.3 billion into crypto and blockchain startups in the 14 months from January 2017 through February 2018. As of 2018, Bitcoin's highest daily transaction volume was approximately 440,000. Bitcoins and other cryptocurrencies are transferred from person to person like cash. Instead of using a bank as a middleman, transactions are recorded in a distributed, decentralized public ledger known as a blockchain. Verification and time-stamping of transactions in the blockchain is performed across the network by a pool of users known as miners. While the ledger records transactions, no one can transfer the asset without a special password called a private key. Bitcoins are stored in a user's cryptocurrency wallet, an encrypted holding place. Much of the blockchain's appeal comes from the fact that asset ownership records are transferred from person to person like cash, rather than using an intermediary like banks or credit card companies if a cryptocurrency is used as a cash replacement. Getting rid of card companies cuts out transaction fees, which can top 3%. Overstock.com was one of the first large online retailers to accept Bitcoin. Its profit margins just 2%. Needless to say, Overstock CEO is a Bitcoin enthusiast. Crypto also opens up the possibility of micropayments or small digital payments that are now impractical because of fees. Think of everything from gum to bus fare to small donations. Cryptocurrencies could also be a boon for international commerce, especially for cross-border remittance and in expanding e-commerce in emerging markets. A blockchain-based transfer would be immediate and could theoretically eliminate all transaction fees, although several firms are charging small fees to ease transactions and quickly get money moved from national currency to cryptocurrency and back. Cryptocurrencies might also lubricate the wheels of commerce between nations where credit card companies and firms like PayPal don't operate and where internationally accepted cards are tough to obtain. Civil libertarians like the idea of transactions happening without the prying eyes of data miners inside card companies, having their transaction history shared by others, or the government. As Wired points out, blockchain technologies straddle the line between transparency and privacy. All transactions are recorded in the open via the blockchain, but individuals can be anonymous. While governments can try to shut down or legislate blockchain activity within their borders, there's no single Bitcoin company or blockchain organization to take to court and force their servers to be unplugged. At its core, blockchains are a standard for securely exchanging value and recording ownership over a network without an intermediary. This has the potential to disrupt all sorts of systems that rely on intermediaries, including the transfer of property, execution of contracts, and identity management. As the Wall Street Journal points out, most documents can be digitized, codified, and inserted into the blockchain, a record that is indelible, cannot be tampered with, and whose authenticity is verified by the consensus of a community of computer users, and not by the discretionary order of a centralized authority. It's important to recognize that while Bitcoin uses a blockchain ledger, not all blockchain technologies use the Bitcoin blockchain. If blockchain transactions are to emerge as mainstream, governments would likely want to link to such systems when ownership needs to be verified. But all this is technically possible to build, and if it works, the disruption across industries would be massive. The Nasdaq Stock Exchange has tested blockchain technology for transactions in its private market subsidiary. A collection of over 45 of the world's leading financial institutions, including Bank of America, Citigroup, HSBC, and ING, have formed R3CEV to build infrastructure based on blockchain technology, and have engaged several national central banks, including the Government of Singapore and the Bank of Canada. IBM has a growing blockchain practice, including efforts focused on managing products in the firm's supply chain. IBM is also creating a whole new firm with shipping giant Maersk to commercialize blockchain use in shipping. Insurer Nationwide wants to put blockchain on your side with a solution to help verify insurance coverage in real time. Overstock.com has used blockchain to issue corporate bonds. The firm has since created its own subsidiary, T0. De Beers, the world's largest diamond supplier, is developing blockchain technology for tracing diamonds from the mine to the customer purchase. Spotify acquired the blockchain startup MediaChain Labs to help the firm build attribution systems. Kodak is developing a blockchain system for tracking rights and payments for photographers. Facebook has a blockchain division run by the former head of PayPal. Foodborne illnesses and a tainted food supply can be a terrifying problem with serious financial and societal implications. The U.S. romaine lettuce E. coli epidemic sickened people across 25 states. In China, a compound used in plastics production had tainted milk, sickening some 300,000 dairy customers. Other recent examples include wood pulp blended with Parmesan cheese, horse meat passed off as beef, and plastic found in chicken nuggets. While RFID tags are being used to track items, another method of following food from farm to fork is the blockchain. One firm experimenting with the technology is the French department store giant Carrefour, which sells 1 million chickens per year. Carrefour's supply chain is set up so that each step along the way is tracked via a blockchain entry. The World Wildlife Fund is using an RFID plus blockchain solution to track tuna from boat to processing plant, potentially keeping your sushi ocean-friendly and healthy. IBM is bringing together major players worldwide in a similar scheme to track items through the food supply. One study estimates that every 1% reduction in foodborne diseases in the U.S. prevents 500,000 people from getting sick, resulting in a net $700 million benefit from reduced sick days and work interruptions. There are several challenges faced by cryptocurrencies, blockchain technologies, or both, that need to be overcome before it makes it to the mainstream. First, consumer benefit needs to be stronger. Second, cryptocurrencies have a reputation problem. Third, security concerns also pose a problem. Fourth, many firms that hope to strengthen cryptocurrency and blockchain technologies have struggled under an ambiguous cloud of not knowing how they will be regulated and what legal issues apply to them. Fifth, volatility is also an issue. Sixth, increased transaction volume should help stabilize the market, increase liquidity, and bring some stability to the currencies, but Bitcoin has a long way to go. Some firms are engaging in a new type of fundraising, widely referred to as an ICO or initial coin offering. Firms raising money via an ICO issue a coin or other token that represents some form of value. While some ICO tokens represent an ownership stake in the firm that can even be matched to voting rights and future dividend distributions like a stock, others simply issue an amount of a new cryptocurrency, for example a Bitcoin rival, or offer usage credits or loyalty points for a given service, usually something they plan on building. The advantage of an ICO for issuing firms is that they can use capital with limited to no regulation. The advantage for consumers is that a token can be instantly traded with anyone, providing the coin or token received is linked to some publicly available blockchain used by both buyer and seller. An investor that owns shares in a public company can trade those shares in the stock market for cash. An investor that makes a private investment in a pre-IPO company has private shares that are less liquid. In theory, the owner of ICO tokens, even those that aren't tied to any sort of equity or ownership stake in a firm, can trade them at any time. If they can find a buyer, there is no need to own publicly traded shares or even the stock market. ICOs got a lot of press in early 2017. The startup Golem, described as a sort of Airbnb where organizations can sell excess computing power, raised $8.6 million in 29 minutes. Brave, a browser startup from a former Mozilla CEO, raised $35 million in 30 seconds. Another firm, Gnosis, a decentralized predictive market platform, raised $12.5 million in 12 minutes. These firms needed to create awareness so that there were buyers for the tokens offered in the ICO. But buyer beware, neither firm had a product that had passed its beta testing phase at the time of the offering. TechCrunch reports that according to its own data, over the 14 months from the start of 2017 through the first 2 months of 2018, blockchain and related startups raised nearly $1.3 billion in traditional venture capital rounds worldwide, but nearly $4.5 billion was raised via ICOs. ICOs are pretty much an unregulated dice roll. In the early days of this model of fundraising, 35% of ICOs failed completely, but 45% showed returns in excess of 500%. There's no guarantee that government entities won't try to step in. A good thing if that helps curtail the possibility of sham ICOs used by scammers. That concludes Chapter 6. Thank you.